Good morning, students. I'm going to go over some key points for Chapter 15. It's entitled Long-Term Liabilities. Here we're going to be discussing bonds. The learning objectives. The first one is describe the major characteristics of bonds and then explain how to account for bond transactions. Long-term liabilities are obligations that are expected to be paid after 1 year. Bonds are a form of interest-bearing notes payable issued by corporations, universities, and government agencies. They're sold in small denominations, usually 1,000 or multiples of thousands. Corporation issuing bond is borrowing money, and a person who buys the bondholder, is investing in the bonds. So types of bonds, you have secured bonds, unsecured bonds, convertible bonds, and callable bonds. Secured bonds have a specific assets of issuer pledged as collateral for the bonds. Unsecured bonds are issued against general credit of a borrower. Convertible bonds can be converted into common stock at the bondholder's option, and callable bonds, issuing company can redeem or buy back at a stated dollar amount prior to maturity. Of these bonds, normally a unsecured bond is more riskier. Issuing procedures. So state laws grant corporations power to issue bonds. Board of directors and stockholders must approve the bond issues. Board of directors must stipulate the number of bonds to be authorized, the total face value, and the contractual interest rate. Bond terms set forth in bond indenture. Bond certificate, typically $1,000 face value. So states, corporations normally incorporate in states that are more lenient toward their type of business structure. And so that's why the state laws, they're saying they grant corporations power to issue the bonds. Normally the state laws are what corporations have to follow. Representing bonds normally represent a promise to pay some amount at designated maturity date, plus periodic interest as a contractual stated rate on maturity amount or the face value. Interest payments usually are made semi-annually, issued to obtain large amounts of long-term capital. Investment company sells bonds for issuing company. So this is an illustration of a bond, different parts of it: the issuer of the bond, the maturity date, contractual interest rate, and the face or the par value. So bond trading, bondholders can convert their bonds into cash by selling the bonds at the current market price on national securities like NASDAQ, things like that. Prices are quoted as a percentage of the value of the face value. Here's an example: the issuer, the bonds, the maturity, close, and the yield. So determining the market price of a bond, the current market price or the present value is a function of three factors: the dollar amounts to be received, the length of time until the amounts are received, and the market rate of interest. A market interest rate is the rate investors demand for loaning the funds. So in this illustration, assume the Acropolis Company on January 1st, 2020 issues $100,000 of 9% bonds due in 5 years, with the interest payable annually at year end. The purchaser of the bonds will receive the following two types of cash payments. They'll receive the principal of $100,000 to be paid at the maturity, and they'll receive 5 $9,000 interest payments over the term of the bond. So the principal and interest payments. So the current market price of a bond is equal to the present value of all the future cash payments promised by the bond. And here is a calculation to show you the present value of $100,000 received in 5 years is $64,000. And the present value of $9,000 received annually for 5 years is $35,000. So the market price of the bonds is $100,000. Do understand that the time value of money typically, the value of it goes down over time. So learning objective 2, explain how to account for bond transactions. Corporations records bond transactions when it issues, which is sells the bonds, redeems or buy back the bonds, when bondholders convert bonds into common stock. If bondholders sell their bond investments to other investors, the issuing company receives no further money on the transaction, nor does the issuing company journalize the transaction. So in the last situation, if you issue bonds to someone and then they resell them, there's nothing that you do. You still account for them the same way you did when you originally issued them. Issuing at face value, discount or premium. So this illustration is good to show you the difference between face value, discount, or premium. So the bond contractual interest rate is 10% when issued. Then the market interest rate was 8%, 10%, and 12%. So in the case where the market interest rate was 8%, the bonds were selling at a premium because you're getting 10% rate bonds at 8%. When it's selling for 10%, it's considered face value because it's exactly what the bond contractual interest rate is stated as. And when it's selling for 12%, it's selling at a discount. So they're receiving 12% market interest rate bonds at 10%. On January 1st, 2020, Candlestick Incorporated issues $100,000 5-year 10% bonds at $100, 100% of the face value. The entry to record the sale is, so this is issuing bonds at face value. So when you issue something, you're receiving something and you're issuing something out. In this case, you're receiving cash and you're gonna issue bonds. So you received $100,000 in cash, which is a debit to cash, and you're gonna credit bonds of $100,000 to put the bonds on your books. Assume that the interest is payable annually on January 1st. At December 31st, 2020, Candlestick recognizes interest expense incurred with the following entry. Assume monthly accruals have not been made. So they haven't accounted for the interest monthly. They're going to account for it at one time at December 31st, even though it's due in January, because December 31st is probably their year end. And so in that case, they're going to do a debit to interest expense, $100,000 times 10%, which is $10,000. And they're going to credit interest payable because they haven't paid it yet. So it becomes a payable for $10,000. So assume the interest payable annually on January 1st. Candlestick records the payment on January 1st, 2021 as follows. So now January 1st has come and they actually have to make the payment that they had in a payable. So they're going to debit the payable for the $10,000 and they're going to credit cash for the $10,000 to actually make the payment of interest. So on January 1st, 2020, Candlestick issues 100,000 5-year 10% bonds for $98,000. So 98% of the face value. Interest is payable annually on January 1st. The entry to record the issuance is as follows. So now in this situation, the bonds are being sold at a discount. So we're receiving cash, $98,000 for $100,000 bonds. So you debit cash for $98,000. Your discount of $2,000, discount on bonds payable, and you're still going to credit bonds payable for $100,000 because that's how much they were when you issued them. That's the value to put on your books is the $100,000 no matter what. So on January 1st, 2020, Candlestick issues $100,000 5-year 10% bonds for $102,000. So now they're issuing at a premium, 102% of the face value. Interest is payable annually again on January 1st. The entry to record the issuance is as follows. Again, you're going to receive cash. This time you're receiving $102,000 because you sold them at a premium. Bonds payable is going to be credited for the same $100,000, but you're also going to credit a premium on bonds for the $2,000 difference. So Giant Corporation issues $200,000 bonds for $189,000. Prepare the journal entry to record the issuance of the bonds and show how the bonds will be reported on the balance sheet at the date of issuance. So these bonds are being sold at a discount. So cash is going to be $189,000. You're going to discount on bonds payable for $11,000. That's the difference between the $189 and the $200. And you're going to credit bonds payable for $200 to put them on the books. Put your bond issuance on your books. And then they're going to show you an illustration for long-term liability section. Bonds payable $200,000, which is the value of the bonds. You're going to have a discount on bonds payable for $11,000, so you're actually carrying them at $189,000. This is the balance sheet a portion of the balance sheet to illustrate the long-term liabilities for bonds. So that's all I have for the key points. I encourage everyone to go through the text, read the text in detail for the exam. Also, I included a glossary with some terms. You need to go through the glossary, understand those terms, and they will help you on the quiz. Have a great day.